Welcome to Smart Women Talk. This is your host, Katana Abbott. I'm a midlife millionaire coach and a certified financial planner, and I search the world for smart women and a few good men, including best-selling authors and thought leaders who are on that leading edge. So join us for conversations on money, business, health, and inspiration, so you can live with more purpose, passion, and prosperity. Hello, and welcome to Smart Women Talk. This is your host, Katana Abbott, and I am so thrilled you're here today. This is another one of my short shows. I've been doing this show for over a decade. Did you know that? And I've been interviewed over 450 guests. You can access these shows now pretty much wherever you get your podcast. But you can also go to smartwomentv.com and you can see it on video. So I'm just thrilled that you're here. If you want to be part of our community and know who the guests are that are coming up, what our topics are, because we've got some fabulous topics coming up this whole year. We do a theme-based easing. You can go to joinsmartwomen.com. You'll get our easing every month. You'll know who the guests are. You'll get free gifts. You'll be invited to great live events, including you'll get a membership for free in our Smart Women Academy with all kinds of great courses. So I hope you come join us. That's at joinsmartwomen.com. So today we're talking about women. We're actually celebrating the whole month, Women's History Month and International Women's Day. We have brilliant guests this month. You won't want to miss them. We have been really focused on this whole concept of all the powerful women in the world, whether it's sports or the women in Ukraine that are fighting for their country right now, and how to stand in your power. And this idea of standing in your power with money is so important. That's what I want to focus on today, because how you handle money shows up in every area of our life. And as women, we often give our power away with money. So it could mean not asking for what we're worth, not speaking up about money, giving that money away when we need it for ourselves. But it also shows up in how we invest, because I'm finding that women don't really understand how their money is invested. So let me just explain. In the past, companies would give you a pension when you retired. This means that your salary would continue. So it could be if you're making $100,000, you would retire and you would get your, let's say, maybe a $20,000 or $30,000 pension that would continue your income. That's what our folks used to get, our grandparents, our parents. But all of that pretty much ended around 2008 during the Great Recession. The pensions that were left, a lot of them were gone. And what does that mean? That means that you now need to become you have to put the money away out of your paycheck for your retirement. The company's not putting it away. And then on top of it, you have to know what you're doing. You have to be able to invest it properly. And that means getting the right amount of growth, but also reducing your risk. So today I'm going to be talking primarily to all of you women who are approaching retirement. So that would be, getting close to 60 and up. It could be women that are already retired. And let me tell you why this is so important. Last September, I became very concerned with what I was seeing, because as I was meeting with women that I was working with, and as I was reviewing the investment statements, I noticed that almost every one of them, even though they thought they were diversified for risk, were in all stock funds or owned individual stocks. But they really weren't diversified. They were diversified in stocks, but they weren't totally diversified. And so why is this important? So I just want you to imagine this scenario, okay, that you have said goodbye to your job for 20 years. And you are just so happy because you're beginning this new stage in your life. You're moving into your third act. That's 60 to 90. You have built up a nice nest egg that you've been adding to for your whole life since you got your first job. And now you know that you get to go explore your dreams and go after your dreams, that bucket list. But then it happens. You turn on the TV as you're getting your coffee out and you hear the announcer say, the stock market has taken a big dip and no one really expected it. And they go on to say what happened, but you kind of dismiss it because you're diversified. You're in mutual funds, so you don't have to worry. But a few weeks pass, and then you open your 401k statement or your IRA statement, and you think, oh my God, what happened here? There must be a mistake. So you call up your broker and you ask her about your account. And she says, oh no, there's been a 20% correction in the stock market, but don't worry, it'll come back. It always does. It may take a few years. And you tell her, oh my gosh, I'm retiring. I need that money. What happened? I thought it was safe and diversified. So let me explain what happened. You were diversified in stocks or stock funds. So when you buy the S&P 500, you have 500 different stocks. So that's very diversified. And actually, that is fine when you're accumulating. So for all you gals out there, that's why this is good you're listening. If you're 30, 40, 50, when the market comes down, you're actually buying the dip. You hear that. People say, buy the dip, because you're dollar cost averaging. Every time you add money from your paycheck, the market's either up or down. When it's up, you're buying less. And when it's down, you're buying more. So it's actually a good thing. But as you get closer to retirement, you need a new strategy. And you want to own both stocks and bonds and even other types of investments. When I say stocks, you don't want all U.S. stocks. So you really want true diversification. So you want stocks and bonds. And so the net result is this should help reduce your risk, but also increase your incomes, because in some markets, stocks soar. And in some markets, stocks decline, but that's when usually bonds shine. So by combining them in your portfolio, you should have a smoother experience. So I would like to show you an example of how stocks and bonds have performed over the long period of time, and then compare that to having a 50-50 portfolio of stocks and bonds. So this is just an example. And so I'm just going to hit a couple highlights, because I know how overwhelming it can be to have a bunch of numbers thrown at you. But we're going to go back from 2000 to 2020 and see what's happened, because we've had a huge, big run in the market. But during that time, we've had some very bumpy times. We had this technology bubble, and that's when technology stocks dropped 77%. That was between 2000 and 2002. And if you had a diversified portfolio of stocks, then this is according to Hartford funds. If you had a diversified portfolio of stocks, you could have lost around 37% if you were 100% stocks. If you were in bonds, you would have made 33% that year. That was between 2000 and 2002. Having 50-50, though, you'd only come down around 6%. And it was similar in 2008. Again, the market was down around, overall stock market, around 37%. Bonds during that time, that was 2008, actually were up 5%. So if you had half stocks, half bonds, you only dropped 15%. So why is this important? Let's imagine that in 2000, you were able to put 100,000 in the market. After 20 years, your stocks, if you had just stocks, they would be 383,000, so almost 400,000. If you had just bonds, they would be at 286,000, so about 100,000 less. But if you did a portfolio of 50-50, you would have had so much less volatility. you could sleep at night, in other words, because you wouldn't have those big drops. But the interesting thing is your portfolio would have ended up at 360,000. That's just 20,000 less than having all stocks. Now, this is just an example. You can't look at the past and expect it to be the future because everything's different. And right now, bonds are in a much different place. I just want to say that back in 2000, bonds were paying 8% in 2000. Actually, in 1987, when I started, they were about 8%. And so they've been slowly coming down over the last 20 years. Now, those same 10-year Treasury bonds are only earning 2%, which means a big drop in your income. So you really need to have a good strategy. So let's see where we are right now and why all of this is important, because we just experienced a very big hiccup this month. And it's been really bumpy. I'm sure you've noticed it, but it was actually healthy. We were expecting a 10% correction. And that's why last September 30th, if you go back, for those who are in our community, I sent out an email with the same subject lines saying, are you ready for the next stock market crash? Because I knew we were due for a 10% correction. And that's exactly what's happened. And that's where we are right now. So my whole purpose of doing that was I was begging everyone, please get with your advisor and find out how much risk you're taking. Make sure you're diversified. So my question to you and why I'm doing this show is we are down 10% right now for those listening in March of 2022. And I'm asking, is it time for you to get a financial checkup? Is your money safe where you have it based on where you are in your life right now? So again, this is for people, women, and even men that are listening and watching, but for where you are for retirement. So that's our focus. So this is why. If you are mostly stock in stock mutual funds, and we have a 20% drop, so we're at 10% right now, but if we have a 20% drop and you have $500,000 invested in your accounts, and we have a 20% drop, that would mean you could lose around $100,000. So if you open up your statement that was $500,000 and you notice, oh my gosh, it's $400,000. I want you to think about that. If you were close to retirement, how would you feel? How would you feel? What would you want to do? Would you want to sell it? Would you get depressed? Would you have to put off retirement? And even if you had 100,000 and you opened up your statement, it was down 20,000 at 80,000, how would you feel? What would you do? So that's what I don't want happening. You can reduce the amount of volatility by having better diversification. So unless you are, if you're not sure, if you're not 100% sure that you're properly diversified and you have the proper amount of stocks and bonds and real estate and gold and financials and all that stuff in your portfolio, please pick up the phone right now. Call your advisor, make an appointment to see how you're invested. And this is what you want them to do. They should be able to run a portfolio snapshot and tell you exactly how much stocks, bonds, real estate, and all that you have. You'll also want to know in those bonds if you have junk bonds or convertible bonds, because those can be more risky. So we really want to know how much risk you're taking for your age and for where you are in life, and if whether you need income, how soon you're going to need income, and you need to know if you should rebalance. So I'm helping women talk to their advisors to take charge of their money, because a lot of times this is a study Fidelity did, that 50% of the women who had an account with a money manager haven't even met with them because they are uncomfortable about talking about money. They're intimidated. And I see this all the time. So the whole point is, I want you to be ready for the next correction, and I want you to have a plan. So now, What happens if you don't have a financial advisor? Maybe your money's in a 401k and you don't have someone, or maybe you want a second opinion. Well, you're welcome to schedule a call with me. I put time in my calendar so you can do that. So I don't manage money. I used to manage 100 million with my partner, but I sold my practice to him. But I do financial planning. I do business coaching. I do what's called retirement income planning for clients. So as a CFP, professional, I'm a certified financial planner. I can do a financial plan that can help you analyze how much risk you actually have, how your money's invested. We can look at creating a cash flow for you in retirement so you can see when should you take Social Security, when are you going to need income, and how to create that income. Because I mentioned earlier that you used to be able to just put your money in bonds and get a real nice safe return of around 8%. So on $1 million, that would be 80,000 a year or 6,500 a month. But you can't do that anymore. You can, but you'd get 2%. So 20,000 a year on $1 million. I mean, that sounds pretty dismal, doesn't it? So that would be like 1,600 a month instead of 6,500 a month. So there are new strategies. I'll be talking about that in another show. But remember, you need to take charge of this. So now I don't just crunch numbers. So I help you uncover your lifelong dreams of what's been sitting on the back burner while you've been busy taking care of everyone else. And then we create an exact detailed strategy, a step-by-step strategy of what you need to do to get there. We make sure there's a buffer just in case there's something unexpected that happens. And the big thing, though, is we do a lot of work around mindset. So we identify those disempowering beliefs. On my last short show, I talked about money personalities, and we help you identify what's holding you back from standing in your power and keeping you from moving forward. And then I show you how to release that forever and create new empowering beliefs. So it's a much more holistic approach. And I've been doing this since 1987. So I've gotten through all those ups and downs, like the Black Monday in 1987, when the stock market crashed 20% in one day. And guess what? I was brand new. So that was called baptism by fire. I also advise my clients back through the 2000 technology crash when the NASDAQ dropped 77%. And it was interesting because we actually helped our clients reposition during that time to about a 50-50 portfolio, like I was talking about. And we got out of technology with almost everybody. Took about a month to do, but that really helped. So they were much more protected when we got to the 2008 correction, where the S&P dropped 48%. So this idea of proper diversification really works. There's something called asset allocation, the efficient frontier model portfolios. And that work is by Markowitz and Sharp, and they won a Nobel Prize in economics. And I use that software. And most good advisors are going to do something similar for you. So today we are dealing with Putin's war of choice. The markets are just going crazy. You know, every day they may be up, they may be down. I mean, hundreds and hundreds of points at a time. And it can create a lot of stress, especially if you're near retirement. So please, please don't wait. Get a financial checkup. Call your advisor today. And again, if you don't have an advisor, you can visit my site. It's katanaabbott.com. You can learn more about what I do. And there's lots of places where you can make an appointment, and you can download my wonderful Midlife Millionaire guide, which will show you 3 different ways to create income for yourself. So again, don't wait, make that call today. And don't forget, we've got Hall of Fame journalist and author Ann Doyle coming next week. I'm so excited. And be sure to join our mailing list at joinsmartwomen.com. And thank you for being here with me today. Until our next show, go out and live with more purpose, passion, and prosperity. Smart Women Talk is brought to you by Smart Women's Empowerment, a 501c3 nonprofit project of United Charitable. Music by Bill Lucas from his album When It Rains. Available on Apple Music and Spotify. Catch us wherever you listen to your favorite podcast, and be sure to join our free community at joinsmartwomen.com to access all our free Smart Women resources.